Attendees are in listen-only mode.
Good afternoon and welcome to today's Premium Account Market Update. The information prepared for general information of traders and investors. The information does not take into consideration the specific needs, investment objectives or financial situation of any person. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hinde, current Managing Director of Global Equity Management and the Investment Manager for the Investor Signals Unit Trust. I have over 17 years of experience in the financial services industry as a licensed securities advisor. The format for today's presentation, we do a quick summary of the macro update driving equity markets. We roll through the full ASX top 50, and during that coverage we look at our recent transactions, our portfolio allocation, and then conclude the recording with a short-term market outlook. The services that we provide are up on screen there. If you'd like to know more about those, please contact either myself or Christine, info@investorsIgnals.com. Up on screen is a graph of the Dow now, with the US equity markets tracking at a slightly above PE, historical PE valuation. I've spent a lot of time during the year talking about the low global bond yields that would have that expectation of PEs tracking above their average, combined with the fact that general consensus is that global GDP is going to accelerate over the course of 14 and 15. What we're starting to see is, even though we're getting better economic data out of the US in the form of recently strong manufacturing data, we saw the November US non-farm payroll report produce a positive number. The concern for the market is, does this mean that the Federal Reserve is going to start pulling back on their $85 billion a month bond buying program sooner rather than later? Either way, the market's preparing for some reduction in that stimulus measure by the US. I think if we balance that with the fact that global GDP, the stabilisation in emerging markets, we're seeing strong growth in India, we're seeing stabilisation in China, we're seeing better data out of Japan within the Asian region, we're seeing better forecasts coming through for Europe. I think it needs to be viewed on a balanced perspective where the Federal Reserve is not going to pull back on their stimulus program if global GDP is not picking up, if the global economy is not supported by other regions of the world. So whilst there may be some initial reduction in that stimulus program, I don't think it's going to be substantial. The market's going to sort of price in and protect itself ahead of that reduction. Arguably what we're seeing at the moment, where the Australian market has fallen a little further than the US, is more than probable that it's offshore capital coming out of the Australian market that has been long this yield trade. And as I roll through the top 50 stocks, we'll look at the names individually, but I think we're getting pretty close to a level where our market starts to find support, especially in some of those defensive names and the US dollar earners that we're largely been positioning portfolio allocations around. Before I move on from the Dow Jones, just to consider where we see probably the maximum downside risk for the US market would be the Dow pulling back to about 14,000 points. From our perspective, that puts it back on the historical fair PE valuation. We'll have a look at the December quarter earnings as we come back in the sort of mid-January period and analyse where that sort of annual run rate of earnings growth is. We're looking for something that supports a number of about 8% EPS growth on an annualised basis, so no reason to think that the December quarter earnings in the US will disappoint or not meet those expectations. So again, our base case is that the market largely moves sideways, and we see sort of the cautious view that maybe the Dow could trade back down to 14,000, but our base case is that if anything, the market consolidates and gradually moves higher again in the early new year. The real driver of sentiment at the moment, it can be sort of seen in the treasuries here, the 10-year notes. We last looked at this a number of months back, and I'd sort of warned that around 3% equity investors start to get a bit jittery. We saw the bonds pull back as there was not the withdrawal of the stimulus that the market first feared back in August, September, and equities continued to perform well. What we're now seeing is a little bit of this pricing in of the stimulus coming out of the US market, and we're starting to see the 10-year Treasuries rally back up to around 3%. And I still think at 3%, the market sort of runs into a ceiling from an equity valuation standpoint, and it consolidates, and it's only when we get that sort of pick up in global GDP that we'll start to see the equity market sort of move higher again. So I think the base case is that we're in for a reasonably prolonged sideways consolidation pattern for equities, which will be finally balanced between bond yields rising and the fact that we do have some sort of underlying earnings growth in equities of around 8%. We've got a slightly improving global GDP picture. And I think that underpins any sell-off that we're having at the moment. So interesting that the Australian market has sold off ahead of the US. Obviously, we've seen a couple of big moves in a few key stocks, in particular, so banking stocks have pulled back. From a yield support, when you consider we had a forecast that the market would spend the most part from March through till the end of December within this shaded range on screen, and if you consider that we called the resistance right through there, we were looking for a sell-off. The sell-off came a little bit quicker and harder than we were expecting, but eventually found support at where we saw value from a yield perspective. The market pushed back above this range here, and we had spent a bit of time in the recordings talking about how a number of stocks were trading down to compressed yield levels that were making them very expensive. Now what I see is we're pulling back into fair range where the XJO is trading on about 15 times forward earnings, and the yield is creeping back up to around 4.5%. So as we go through the top 50 stocks, I'll look at some of those specific PE valuations and yield forecasts into 2014 earnings. But I'd expect our market to broadly start to find support at or near this current level. So on that note, let's move straight into the top 50 and we'll review the individual stocks. So AGK, we're not looking for anything too surprising in earnings season. I think flat earnings, so at around 14.50, the stock's fair value puts it on just under a 5% dividend yield, trades at about 13 to 14 times forward earnings, and we had sold calls largely over our AGK holdings up at around 15.50 into that March period. So we would expect the stock to find support but move sideways through here. We'll collect that dividend in the first quarter of the new year and the call premium, and hopefully have the opportunity to reset that position. But certainly at or near this level, I'd expect the stock to start to find some level of support. Asiano's getting down to our target. I'd always had a view that around this $5.40 to $5.50 the stock's worth a look at. The interesting story with Asiano is the prospect that they'll grow earnings somewhere between 5 to 10%. So we haven't set positions in Asiano yet. We'll wait and have a look and see what the earnings are like in the February-March reporting period, or the February reporting period. But certainly at around 5.50 puts the stock on about 14 times earnings, about a 2.5 to 3% dividend yield. The company's only paying out about 30% of its earnings in dividends, so there's prospects, if earnings hold up, that the company could increase that, and I think that's the story for Asiano. So if it gets down deep enough value, happy to start to take a look at that in the new year. Amcor, we continue to hold Amcor. It is at the top end of its valuation range. We've got the spin-off of Aurora coming up in about at the middle to end of next week. Our strategy there will be essentially to sell off the Aurora Australian Packaging Division shares and continue the long exposure to Amcor. For clients that are not currently holding it, we'll look to reposition post that spin-off of the Aurora asset. But up at these levels, the stock trades on a forward PE of about close to about 17 times earnings, and we are looking for EPS growth somewhere around that 8 to 10% from the international division. So I look forward to reviewing Amcor in January post that spin-off, but continue to certainly like the business, and we'll look to continue exposure to Amcor. AMP at these levels, we're not expecting much earnings growth. The company's already warned that they're going to miss the original guidance, so it's not a name that we're active in or attracted to it. probably somewhere down at around $4 may be worth taking a look at it, but it's another one of those names that we'll review post the earnings results coming out. ANZ, so in general, all the banks I think are now down at levels where they start to look attractive again. We're really hedged on the banks in that in most cases we own them at lower levels and we've either sold calls at or near the current prices. So and we do own them in some cases at a little bit higher level, but even if the stock pulls back a little, hopefully we don't get exercised under those lower call levels. We reset the average. I do think the banks will rally in the first quarter of the new year, if not sooner. But they're trading now, pushing back up towards a 6% dividend yield, and I think relative to bonds, the banks will be attractive and well supported, especially considering that there is, although the unemployment rate's picking up a little in Australia, and there is some concerns around the mining sector and are there troubled debts or loans ahead, that are yet to be disclosed from the mining sector. So they're probably the two negatives, the unemployment and the slowdown in the mining sector. The positives are obviously that we're seeing a re-acceleration in loan growth, both at a residential and commercial construction level, and also at a gradual pickup in business lending as well, albeit that's fiercely competed between ANZ, NAB and Westpac at the moment. But from a valuation standpoint, 6% dividend yield, about 5% underlying earnings growth in 2014. The bank should be well supported, and I think they're getting down to value at or near these levels, and we're acquirers of them, continuing to acquire them at or near these prices. ASX, so I've spent a fair bit of time looking at this and chatting about it throughout the year. At around $37, we had a view that it was getting pretty expensive. We are capped out on the covered calls up at around that level. We got very good premium for those for around $1. So our effective exit price into the March period, allowing for the dividend, is that we're sitting up at around $39. I think the stock trades sideways. It should find good yield support at around $34.50, and I think at around $37.50 it gets a little bit expensive. I'd expect to continue to sort of track it sideways within that range, mostly into 2014. We're not expecting too much from an earnings growth standpoint in ASX, and it puts it on a yield at the moment of roughly 5%. AZJ, we continue to like this name, albeit that the stock is expensive, trading about 19 times earnings. Ideally we're strong buyers of it back down here at around sort of $4.45, but certainly the range is sort of from $4.50 to $5 into the first 6 months of next year, and we're happy to sort of trade the stock on that basis. BHP, the stock's pulling back to about 13 times forward earnings, trading on about at about a 3.5% dividend yield. In most cases, we've managed to sell the covered calls up at around this sort of 38 to 39.50 level. I do think the stock finds support and largely sort of tracks sideways in line with our view on the broader index. Brambles, so we've seen the spin-off now of the recall assets. So value for Brambles is probably sitting here somewhere around this $8.50 level. It puts it on a forward PE of about 17 times earnings, puts it on a dividend yield of about 3.5%. I think a combination of its exposure to US dollar earnings and the falling Aussie dollar continues to underpin Brambles. I think somewhere down here at around between 8 and 8.50 the stock finds support, and really its new trading range post the demerger is probably somewhere between $8 to $9. The stock will consolidate and move sideways, looking for about 5% EPS growth out of Brambles in 2014. CBA, again, from historically sort of sitting at around a 5% dividend yield, we're now starting to look more attractive back down at a 6% yield. We've largely taken profit on CBA, so it's only if it was to pull back down to around $70 that we'd look to acquire CBA. At the moment, the preference is probably ANZ, Westpac and NAB, albeit that CBA is the next one in line to pay its dividends. So certainly if the discount gets deep enough, we'll become attractive to CBA. Again, across all the banks, underlying EPS growth in 14, probably somewhere around 5%. Coca-Cola, so down here we start to get some level of yield support, even allowing for a slight reduction in the dividend yield. I've got it at around about 5% dividend yield on a forward outlook. The stock trades somewhere at around sort of 15, 16 times earnings. I think we're likely to find support here. The range is probably somewhere between 11.75 back up to around 12.50 in over the next 6 months in Coca-Cola. From an earnings outlook standpoint, we're not expecting too much in the February numbers. I think Coca-Cola will be doing well to report numbers that are in line without sort of disappointing the market again. Not doing there in CFX computer share, so we'd always sort of had a view, whilst it's attractive, we like the US dollar earnings, we like the fact the underlying business should grow 5 to 10%. At around $11, the stock was getting very expensive, trading up at around 19 times forward earnings. We own it at lower levels. We'd sold the covered calls predominantly around this sort of 10.75 level. I think that sort of puts us in the right price point. The stock could either pull back a little bit further going into expiry next week, and we'll get the opportunity to reset the calls again, in which case we'd keep them pretty close at around that 10.75 level, or alternatively the stock sort of bounces around these levels and we get an opportunity to deliver the stock, in which case we wouldn't rush to jump back into computer share, sort of to buy back in at around $10 would be an attractive entry point for computer share. CSL, likely to get some support from the ongoing share buyback that the company's doing. From a PE standpoint, the stock's still quite expensive. We do own it throughout this sell-off, roughly at around this $66 level. We've gone out and sold the $71 calls into June next year. We've got good premium, around $2.50 for those. I think CSL will find support on this sell-off, may get down to sort of $64, $63, but ultimately fair value is probably somewhere between 64 and 68, and we'd look for CSL to track sideways, should deliver about 10% EPS growth in the 12 months ahead. Not doing there in Crown. Dexus has come back and trumped GPT again, so we've seen a higher bid there, which may not be a bad thing. I'd probably be a bit disappointed to see GPT get too aggressive, so we'll wait and see what happens, but certainly Dexus upping their bid now and for CPA. Fortescue, the company's been disciplined in paying down their debt, which has been very encouraging. Our preference within the resource space still remains Woodside and BHP. So we're generally not long owners or long bias towards Fortescue. For clients that do have small allocations to Fortescue, I start to sort of have a view that up these levels, the stock's sort of getting reasonably full value across the next 3 to 6 months. Our expectation is the stock price probably struggles to move too much higher in the short term. Fox, we like this name, US dollar earners, and delivering about 8 to 10% EPS growth. The company's buying back $4 billion worth of its shares. I'd expect it to find reasonable support on any sell-off. We're owning it at or near these levels, selling the 39 covered calls out into the new year, collecting roughly $1 for those. And I think that this is one of those names that should benefit from any sort of rebound in equity markets, post this current sell-off that we're going through. Goodman Group, getting more attractive from a yield standpoint. You can see on screen they're down at around sort of 430 to 450. The stock starts to get attractive back at 5%. So there's been a pretty substantial readjustment in these property trust names where yields were getting down to high 3s or low 4s. We're really, even in an environment where our interest rates are set at 2.5%, I'd expect Goodman Group to be these property trusts to be yielding somewhere back up at around sort of 5%. So I think they're only now getting down to levels where I'd expect them to find support. From an earnings growth, Goodman Group somewhere around sort of 4 to 5% EPS growth. GPT down at these levels I think starts to look attractive on about nearing a 6% dividend yield. The company's reaffirmed guidance of around 4 to 6% EPS growth. Again, if they don't come back and try to Trump Dexis's revised offer, I think GPT should see some type of relief rally and trade back up towards that sort of 360 level is where I start to see fair value for GPT. Not doing there in IAG or Iluka. IPL trading about 10 times earnings. The stock's probably representing some reasonable value down here. I do think it's obviously a 2014 or late 2014, 2015 recovery store. It requires DAP prices to improve from the current low levels when you consider DAP prices have fallen from somewhere around sort of 480, 500, down to sort of the high 300 range. And so whilst IPL's production numbers have improved, they are a slight beneficiary of a lower Aussie dollar. The falling DAP prices have made it difficult for them to grow earnings. So it really is a story of, are we at the bottom of the cycle for DAP prices? And I think we probably are. I'd expect towards the end of 14 and 15 to see that backdrop improve there, and that should help to underpin some earnings growth for IPL and see a turnaround in their share price. Lendlease down at around 10.50. The stock starts to look okay value, trading at around a 5% dividend yield and about 10.5 times forward earnings. This will be an interesting stock to have a look at the earnings result out in February. We'll look for something around sort of 5% EPS growth, but confirmation that the companies guiding towards sort of 5 to 10% EPS growth in the sort of into 2015. But again, down here at around $10 to $10.50, I think the stock starts to look attractive. MGR, we'd sold this up on the highs here at around 178. Again, as the yield starts to improve, back down here at around $1.50 starts to look interesting again. Not doing there in Macquarie at the moment. NAB, I think, as with ANZ and Westpac, or whether today's the day or over the course of the next week, I'd expect us to be getting pretty close to finding yield support on these banks, given that there doesn't seem to be a lot of risk to the earnings outlook over the next 12 to 18 months. So I'd expect sort of buying interest to start to come back into the banks at or near these levels. 5% underlying earnings growth, tracking at around a 6% dividend yield now for NAB. Newcrest Mining. Now this is putting aside the falling gold prices, what we're looking for here is either confirmation out of the board that they're going to engage in a capital raising. It'll be done at a discount. Now, the board is probably of the view that they've got a little bit of time, albeit the markets, punish them for not making the tough decisions. And those two tough decisions really are, do they close down their high-cost production and essentially create sort of a good Newcrest, bad Newcrest, close down the low-margin or negative contributing production sites, focus on their low-cost production, which is arguably somewhere up around 1 million plus tonnes, so over 50% of their current production. Even with gold at current prices, they could return to profitability. I think that the company's either faced with that as a decision, which is a tough one, or doing a deep discounted equity raising or a rights issue. They do have about 18 months, 2 years before their debt facilities require rolling over. So whether the company's forming a view that they're expecting gold prices to improve over that period, obviously that's a fairly risky call. So we wait to see what the final decision of the board will be, but I would expect to see something over the next sort of 3 months. Quite often when you see sort of them bite the bullet and make one of those two tough decisions, or possibly making them both, then I'd expect to see Newcrest gradually recover, albeit it will require an improving gold price for it to ultimately begin some type of structural uptrend again. I still think at a macro level the argument is there for a stronger gold price longer term, given again the indebtedness of the Western economies and the need for emerging markets to continue to diversify their portfolios to include gradually higher allocation towards gold. So that's essentially the story there for For Newcrest, Origin Energy, we'd sold the covered calls into December at around this 14.50 level, so we're benefiting, from this slight sell-off at the moment. Somewhere back down around these levels, it starts to look attractive again as the yield pushes back up to around 3.5%. Again, one of those names that we're not looking for too much positive earnings bias coming through in February. I think if they can deliver flat earnings and then give a more bullish or positive guidance towards 2015, then that's probably all the market's looking for. So we're generally not, we own Origin from lower levels. We've sold the covered calls. For as far as new money coming back into Origin, maybe somewhere down here at around $13, I think it starts to find support from a yield standpoint. Not doing there in Orica. Oil Search, we'd largely taken profit on Oil Search and we're looking for it to move lower, somewhere back down at around this 750 to 775. I think starts to look interesting again for Oil Search. Not doing it there in Qantas at the moment. So we're seeing QBE. So thankfully we'd taken profit on QBE up at around this sort of between 14.50 and 15.50. So we're not carrying any long exposure in QBE, albeit it was starting to creep back onto the radar simply of the view that US interest rates are starting to rise and maybe QBE had a better macro environment. But the troubled balance sheet of QBE, I think, which was the reason why we took profit in the first place, is that there's always been some question marks about whether they had really dealt with all the write-downs essentially that had existed in their portfolios from possibly even as far back as the GFC days. And I think in some respects some of that's still coming home to roost at the moment. Hard to really know where support ends up being for QBE, so our preference is just to steer clear of it for the time being. Rio, we're seeing commentary out of the company about increasing their production of iron ore up to 360 million tonnes per annum. That's really a 2015 story. Could drive earnings up to another sort of 10% as we see that production level sort of increase from current levels up to around that 360 million tonnes. From a valuation standpoint, the stock trades now at about 11 times forward earnings and trades on roughly a 3% dividend yield. We had sort of a full value at around $68, so for clients that own it at lower levels, we'd sold the covered calls at around $68, collected some income. I think sort of taking into account this current sell-off that equities are going through, maybe Rio could trade back down to around $60, but we're not looking for any major adjustment in iron ore prices. I think they continue to bounce between 130 and 140 a tonne, which should mean that we start, get into an environment where Rio probably finds support at $62 and then sort of tracks sideways. Albeit that, again, we're not sort of our preference is BHP and Woodside overexposure to Rio. So Stocklands, I think down here the argument is that it certainly has good yield support, getting back to around 6% dividend yield. The company's confirmed their guidance of 4 to 6% earnings, and I do think it gives some exposure to the pickup in the Australian property market. So maybe at around sort of 350 it finds support again. We broadly own it at lower levels from back here at around this 340. We'd sold the covered calls at 420 into March. We'll collect the upcoming dividend, and I've always maintained that whether we end up delivering the stock under the covered call at 420 or Stockland just simply bounces sideways, we collect the dividend yield, we collect the call premium, we'll be driving around 10% cash flow out of Stocklands. I wouldn't expect it to trade too far out over 2014 out of our range of sort of 350 support and around sort of 410, 420 certainly being the resistance level in Stocklands. Sonic, not doing there at the moment, although it starts to come back onto the radar at around $14.50 from a valuation and yield standpoint. The stock looks attractive. We'd taken profit on Santos some time back. It's only if it gets back down around this $12.50 to $13.50 level that we start to take another look at Santos. Not doing there in Suncorp. Sydney Airport's down around $3.50, starts to look interesting. Our Transurban exposure, the stock's coming up to paying its dividend at the end of December. Again, our base case here is that at $6.50 the stock is good value at a 5% dividend yield, with the company gradually increasing dividend payout over the next few years. Back up at around 7.25, the stock starts to look expensive. We continue to be buyers of it on this sell-off, and a push back up to around 7.15, we'd take the opportunity to resell the calls at 7.25. Telstra, so I think coming into the February dividend, I'd expect the stock to find support, pushing back up towards a 6% dividend yield now, and I think the range is supported around 6% dividend yield, resistance up at around 5%. So really, I think sort of from this sort of 4.95 back up to 5.25 is where we see Telstra continue to track. Toll, at around 5.50, the stock starts to look okay value. From an earnings growth standpoint, the company should deliver about 5% earnings. The stock trades on about a 13 times forward earnings now, roughly on a 5% dividend yield, which is sort of ties in with what I've maintained for a little while. At $6, the stock's expensive. At 5.50, it starts to look attractive. So we're happy to be gradual accumulators of Toll at or near these current levels, and then sell the covered calls back up at around that $6 level. Westpac, I think again in line with sort of NAB and ANZ, we're starting to get down to levels that look interesting again for these banks. I'd expect it to find support over the next week or so at or near these levels. WDC, our view here is it's interesting. Obviously, we've seen this announcement where WDC will be spinning off their Australasian property assets to merge them with WRT. I don't think at the margin it particularly unlocks value for either entity, but what we're seeing is this adjustment in yield where the market was paying sort of a 4% dividend yield for Westfield up here, but now it's been repriced down on a sort of 5.5% dividend yield, in line with the adjustment that we've seen in the broader property sector. The expectation is, though, that at sort of 5.5% dividend yield, these property trust names find support and gradually move back up to sort of trade somewhere around sort of that 4.5% yield for the most part of the early stage of 2014. So I do think they actually present value as they near this sort of 5.5% dividend yield range. Wesfarmers, as with Woolworths, starts to look attractive from a valuation. I think, yes, it is trading on a high PE. At 4.5% dividend yield, it was expensive. At 5% dividend yield, I think the argument is that some of these names that have strong low-risk earnings growth should find support at or near these levels. So as far as sort of new allocations goes, Woolworths and Wesfarmers are names that we like in the current market. Not doing there in Worleys. I think, as I just mentioned with Woolworths or Wesfarmers, Woolworths is now getting down to a sort of 5% dividend yield support range. At around this level, I think it finds support, trades back up to our target of around 34.50, and we look to sell covered calls as the stock approaches sort of that top end of that resistance range. And Woodside Petroleum should deliver about 5 to 8% earnings growth, trading on roughly a 5% dividend yield at the moment. Our expectation always is that around $39.50 the stock's expensive. At around $37, I think the stock provides reasonable value. I'd expect it to find support maybe somewhere around $36.50 and then track higher into the early part of the new year. And finally, just to finish there on WRT, so as we've seen with the other property names, where albeit that Westfield was always trading on a high dividend yield around 5.5%, we've seen sort of that full 1% stripped out of the yield pricing on these names, but it has found support at around this 280 level. I think maybe the new range is sort of somewhere between 290 and 310, but that's fairly consistent with where we've positioned ourselves and sold the covered calls up at around sort of this 320 level. And we'll continue to sort of roll that strategy forward into the new year. So just to recap in today's recording, let's just revisit a couple of the names that we're happy to continue to allocate capital towards on the basis that we see that the market will largely move sideways and some of these yield names will find support. So ANZ looks okay at these levels. I think BHP continues to look okay, and we'd be buyers of BHP and happy to continue to hold it. I think Brambles looks okay post the recall spin-off. I think it'll find support at or near this level. It makes sense to keep these US dollar earners in the portfolio. So that includes CSL with their share buyback. The stock is expensive, so it is a name that at best we're just thinking that it moves sideways. But I think the the $900 million share buyback they're conducting and the US dollar earnings should continue to support CSL's share price. GPT on the property side, getting back towards a 6% dividend yield, the prospect that they pull out of the CPA, bidding more. Hopefully we see the stock find support here and track back up to around that 360 level. NAB within the banking space, as with ANZ, I think starts to look attractive down at these levels. Rio, I spent a bit of time on that. We'd sold the covered calls up at 68. For our liking, it was just starting to get a little bit expensive. I think Stockland's in line with the adjustment in the property plays, getting back to around a 5.5% dividend yield. Stockland starts to look attractive. TCL coming into its December dividend, I think should find support at or near these levels. Westpac Bank, we continue to like that on the basis that it's getting down to sort of again nearing a 6% dividend yield with 5% earnings growth. Woolworths we like, 5% earnings growth outlook, 5% dividend yield, starting to get back to attractive valuation levels. And Woodside Petroleum, I still think sort of the oil and gas space is probably the right place to be, which is why our preference is for BHP over Rio. And then finally to finish, for the last recording of the year, so obviously we'll be continuing to monitor the market closely and manage client positions, and we'll communicate with clients on an individual basis over the Christmas period as needed. But broadly our base case is that the market starts to find yield support, and if we're selective in the names that we have exposure to, the likes of Woolworths, Wesfarmers, a couple of the banking stocks, a few of the property plays, I think we should be the beneficiary of seeing a gradual recovery in those names into the first quarter of the new year. Thank you for listening in. I wish everyone a Merry Christmas and enjoy your holiday season.